Hi all, welcome to the Crypto Tax Update by BerChain in collaboration with Pekuna. I'm Stefania Artusi from BerChain, and at BerChain we are a non-profit member-led association based in Berlin, connecting and promoting the Berlin blockchain community from throughout the blockchain ecosystem and beyond. And one of our goals is actually to position Berlin as the global blockchain capital. At BerChain, we facilitate science and research activities, education around the topic of blockchain, through which we promote the local Berlin blockchain ecosystem. Many of you might have watched with great curiosity the previous crypto tax episode here on YouTube. We recorded in 2020, but since the latest updates in Germany on crypto taxation, we decided to record an update for this. And for this reason, here with us today, we have Werner Hoffmann, CEO and founder of Pekuna, one of our members as well. Welcome, Werner.
Thank you.
Who organized actually this crypto tax update with us. And today is all about uncovering the document titled "The German Income Tax Treatment of Cryptocurrencies and Other Token," released on May 11th, 2022, plus a few more questions we gathered around within the community and via our Slack channel. So I'll start asking you to give us a bit of background about yourself and Pekuna, and to explain to us a bit of background about this newly released taxation document.
Yeah, of course. I mean, that's why we're here. So my background is I worked for the tax offices. So I studied tax law, I have a degree in this area, worked for the tax office for almost 10 years. Always was very technically interested. I then decided to study computer science and also have an actual technical proper degree and background. And that's also when I got in touch with first, of course, Bitcoin and other cryptocurrencies later on. And then I realized, hey, that has tax implication. And even though I'm working for the tax office, I still struggle doing my own taxes. And I think that it was like another year that it took me to like do my research and realize that that is actually a big problem, and to solve it for myself first, which led ultimately to the founding of Pekuna in, I think, 2019. It was a couple of years ago also. And yeah, then we like got into the community, got our first clients, and also are now very active in contact with politicians, with state offices. I think we're like one of the big go-to addresses at this point for all German tax advisors as well, to clarify questions around crypto taxation. I have like a very big knowledge area, also a couple of employees who help us with the reports. So our main product is helping private people to create a report for their own taxes. As this is like a manual process, very work intense, very like knowledge heavy as well, it really only makes sense for like bigger portfolio values. So if you only trade a couple €1,000, it's not really worth reaching out to us, as our product is quite expensive. But like once your portfolio value is in the millions, then it usually does make sense to work together with us, because then we also like will help you to structure your crypto assets, what to look out for in terms of taxation, what are tax risks also, and like be your go-to person for all kinds of questions. Also with state governments, the German tax office, we're in very close contact. So for I think 2 years now, we're working together with them. Like try to regularly give them input on their clarification that was now expected for many years to be published, or for at least 1 year to be published. And yeah, now in May this year, it finally happened, and we've got now finally some clarifications around the area of crypto taxes in Germany.
Great. And just let's have a little bit of background about this newly released document. And yeah, what does actually means?
Yep. So it's a clarification. It comes also from a state office. It does not come from the government or the parliament. So it's not an actual, like, it is a legal document, but it's not a law. That's what I want. That was the word I was looking for. It's not an actual law. The laws are already there. And now the question is, how do we interpret them when it comes to new asset classes? And in this case, cryptocurrencies. That's something that's done quite regularly, because the Ministry of Taxes, one of their jobs is to make sure that taxation all over Germany is the same. And therefore they do like some guideline papers, I would call it, some clarification papers. And that's now one of them. There is like probably hundreds of them published to all kinds of different cases. They are legally binding for the tax office. So every tax office in Germany now has to comply to what is said in this document. And therefore, like, all the questions all over Germany are answered the same way, no matter if you go to a tax office in Hamburg, Berlin, or Munich. That's the actual big thing. And on the other hand, it's also a little bit of an acknowledgement for the crypto scene, I think, because now it's like, oh, there's it's a state office that really brings out I think it's 20 pages guidance, 25 pages guidance for regulating crypto assets. So that shows there is actually something real behind it.
Great, thank you. And how have you been involved with the Ministry of Finance who released this update in terms of this publication?
Mm-hmm. So there was already a draft out there. We were already a little bit in contact before that with some employees of the Ministry of Finance. Then last year, they published a first draft for that paper where everybody was invited to give their opinion on. That's also something we did with Pekuna, and many others stated their issues and gave input. I think our statement for the original draft was longer than the draft itself. I think the draft was also something around 20 pages, and we gave I think 30-page statement for that. So there was a lot of work that went into that to really point out what could be problematic, especially for the crypto scene, and also reporting wise, how do you do that, and compliance wise. And there was very good, and a lot of cases weren't regulated at all. So we had a very big letter here that we wrote to the Ministry of Taxes. Later on, I was also invited to another meeting where we could point out these things again, and where there was an open discussion happening. And just recently this year in April, I was invited to the Parliament, where also a couple of people from the tax ministry were present, which also discussed this draft again, and where they already gave a couple of other things that they are planning to do. And then it was a couple of weeks later when they actually published the paper. So it was a lot of the meeting was about this clarification letter from the Ministry of Taxes. So, yeah.
Well, it's a luck you've been involved, actually. And but let's go now to sum up a little bit the clarification document. What are the positive aspects of this document, in your opinion?
Mm-hmm. In my opinion, the positive aspects are mostly that the 10-year holding period for staked assets is not coming. That was like a huge discussion for also staking and peer-to-peer or lending in general, also for DeFi. There was always this thing going around that it might be a 10-year holding period. In Germany, we have the time that between buy and sell is a 1-year period. It's completely tax-free. And under certain circumstances, this 1-year period could be extended to 10 years. But it was not clear if any of what's happening in the crypto space, especially staking and DeFi, it will lead to this extension to the 10-year period. And that is clarified now that this is not the case. So that is definitely by far the biggest aspect, and also opens up a lot of opportunities in Germany for using staking protocols, lending protocols, DeFi, liquidity mining, and so on, like all these different DeFi interest generating components that you can use are now legal and also don't create a huge tax disadvantage. And especially for staking, I think it's really positive to support the infrastructure also in Germany, to have a huge staking infrastructure as well, and to not give a tax disadvantage by making it a 10-year holding period, I think is a really good thing.
Great, thank you. Then now I would say let's get to the negative aspects, in your opinion, of this clarification document.
There was a couple things that I would have liked to see different. The one big thing is that, again, staking, if they're now having a new area or a new distinction, they distinct between, I would call it active and passive staking. So active staking means you're actually operating a staking node. You're actually creating new blocks for the blockchain. That's called active staking. Passive staking, therefore, is everything like in DeFi staking, you put money into a protocol kind of staking, or you're using a staking provider, or also you are doing delegated staking. This is considered passive staking. And for active staking, so if you're operating your own staking node, it means you're a business, and that comes with a lot of obligations. You're required to do a different. So first of all, the taxation itself is, so whenever you sell it, it's tax involved. There come additional business taxes on top. Your reporting is expected to be a lot more for businesses. So there is a big overhead for this active staking so far. Another thing that was rather negative was for the fork. Whenever a fork is happening in a blockchain, the tax ministry says that you have to go back in the past and actually split up all the transactions with like whatever percentage the fork, the old and the new coins were. So if I have between like Bitcoin and Bitcoin Cash, I don't know what it was, but let's say it's like 1 to 9, so we have overall 10 was the ratio. Then I have to go back, and all Bitcoin transaction before the fork happened have to be split up in this 1 to 9 ratio. So with that, it means that 1/10 of my buying costs of all my Bitcoins are going to Bitcoin Cash, and therefore are not lost, but not what I really wanted. Like when I bought Bitcoin 2 years before the fork happened, I wanted to buy Bitcoin and not something potential fork coins that happen in the future. Therefore, it first of all makes a lot of work for us as somebody who writes and creates reports in that area, that we need to manually split up these transactions. And on the other hand, for the investor, it also means that their cost basis, so what they can deduct from taxes, are melted down step by step. So I did some research, and just for Bitcoin, there were over 100 forks. Basically only Bitcoin Cash and BSV are still around. Everything else is worth 0 at the moment. But if you would really go back and for all of these 100 forks, whenever they happened, create all these transactions, that's basically impossible to do in the real world.
Yeah, understood. Yeah, like also regarding this clarification document, anything that was new and surprising for you to see on it?
One surprising thing they did, which I thought is on one hand very smart, on the other hand very sneaky. So far, when you receive an airdrop, then it's considered tax-free if you didn't have anything to do with it. That was like opinion before, and is also like written down in this statement now. What they did now is once you sell the airdrop, they say, no, you received that for free. So you still have you don't have to tax it once you receive it, but once you sell it, the 1 year holding period still counts, and it is using the acquisition or production cost of the person who had it before you. So if you got it for free, then whatever cost was related to this airdrop token beforehand is now considered your buying price. As we usually don't have a buying price for an airdrop for a previous owner, sometimes there wasn't even a previous owner. If it's a minting airdrop, which these days most of them are, then that's zero. So they like sneakily got in and said, okay, you got it for free, but it's like value zero. And if you sell it within the 1 year holding period, then you have to pay the taxes. So they still kind of are fully taxing airdrops because all you can deduct is your purchasing price, and that's zero. So that is something that is actually new, and that was not part of the draft, and also not something that I've heard before. And I'm curious what some courts will say in the future about this regulation. I could imagine that some people are suing against that.
Okay. Anything you would have liked to see on the document, like anything that is missing in your opinion?
That's actually quite a lot, yes. Here you can see a little bit that it's still a state office. I was really positively surprised, like how their knowledge base increased, how open they were talking to me personally, to Pekuna, to the community overall. But they are still a couple years behind. I think they've heard of like newer things as well, but I would say that what they published is basically crypto of 2017 or something. We're still talking a lot about forks, about ICOs, about all these kinds of things. Everything newer, I would say DeFi, liquidity mining, NFTs, all the newer things, metaverse thing. That was one of the questions I also had, like how it is a property in the metaverse. Is that taxed? Is it like a property, an actual property? Because then taxation would again be different. That's not part of the statement so far. So there is still quite a lot of areas missing. That was like one of the biggest complaints in our last statement that we wrote to the tax office, where we pointed out all the areas that still need more regulation, because there are still like gray areas, open questions, especially for us with our clients. There's like a lot of things that we still need to find our own regulations and arguments how we think this is taxed.
Okay. Is this, just to be clear, is this already a tax law, or which kind of, like clarification, but like what's the status at the moment with that?
So, it's officially published. That's all this paper needs. As I mentioned earlier, it's not a law, so it doesn't need to go through Parliament or Congress in Germany. So it's really just from the State Office of Taxes. It only applies to the tax offices, but of course that affects every one of us. So as a citizen, you can still disagree with that. That's totally fine, and you can also sue against it, and also the courts are not bound to that. Also the government is not applied to that, so they can at any point change it. As it is only a tax clarification, the law was always the same. So there's also no, what it's called in German, like protection of knowledge or protection of the past. So if you make a new law, you usually can't make it for the past. You can't make a law that starts 2 years ago. You can only make laws for the futures and changes. So citizens can rely on what the current law is and don't have to be afraid of future law changes. With this thing, it's different, as the law is already there. It's only a clarification of how it's supposed to be interpreted. It also is supposed to be used for all open cases. Like if there is a court ruling, or not for court, but if there's like a really old case going on that's for some reason still open from 2017, they would still need to use this clarification paper now to do the tax assessment.
All right, thank you. Now, let's zoom out from Germany and let's go to a wider perspective. The MIKA regulations draft adopted since March 2022. For those who don't know, the MIKA stands for Markets in Crypto Assets Regulation, and it provides a legal framework for crypto assets markets to develop within the European Union by clearly defining the regulatory treatment of crypto assets that are not covered by existing financial services legislation. So in your opinion, how this is impacting Germany's market and regulations?
I think there will be a big impact. That was also like, or one of my questions to the tax office was, why are we not getting like a complete, like an actual crypto tax law, like it's already happening in Austria, like it's already happening in France, where, for example, like crypto against crypto, I think that should be tax-free, because you don't actually have assets to pay taxes, and that would require an actual legal change. And the answer was they want to wait for further regulations, do like the groundwork, to do the regulatory work first, and then tax law will build on top of that. So I'm very sure this might, I mean, I know it has an impact on Germany. The MIKA, I think, is like a basic regulation, and it also mostly applies to financial institutions. I'm not 100%. I haven't read the 200-page document. I know the discussion that are going on and what is part of the MIKA, also the discussion around the unhosted wallets and things. I think overall on the crypto space, it will have a huge impact. On the tax space, it might even have a positive impact, because then we have like first the like overall legal groundwork based on MIKA definitions. Tax law will create their own law, maybe property law will change, and so on. So all other areas in regulatory aspects will build on MIKA and others that are currently discussed. So there's also, have you heard of CARF, the Crypto Asset Reporting Framework?
No.
That's another, it's from the OECD, and they are working on a reporting framework. That's something that's also currently going on, that will regulate how exchanges have to report to governments about crypto assets. So that, of course, has a huge impact on taxes later on, because what will this data be used, of course, for taxes. So also here, will have quite some impact, I think, on the German and European ecospace.
Yeah, well, thank you for the insights, Werner. And
welcome.
We actually finished our questions, but now we have a community question, which is actually coming on VAT on NFTs, which is also something you were mentioning is not really clear from this clarification document. So we had this question, like NFTs are treated as cryptocurrencies with that holding time of 1 year, that causes then tax implication or no tax implication, question mark. And also, like, let's clarify the situation of play per earn and maybe NFTs that contributes native RCE 20 token over a limited time frame. And these are ERC20 tokens, are their native currency, but they're also traded on, you know, like DEXs. So like, what's the stand there? And if you can, you know, like give us an insight also on this. Thank you.
That's now a lot of questions squeezed in one together. The brief answer is that's not regulated at all from this paper. So it's really about sorry, it's all things about income taxes. So it regulates private taxes and also for company income. So VAT is like a whole different tax area here. Also, NFTs are not mentioned at all. I will still try to like answer a little bit of the open questions. What's my current opinion? From official side, we don't have any insights yet. So NFTs are treated not as cryptocurrencies, but the same as cryptocurrencies. So they're also considered other assets, and therefore also with the 1-year holding period. And that's like all the same as if it doesn't really matter if it's like a coin or a NFT. Then the next part was the play per earn thing. Here is the question, is it a business income or not? I would say for all these where the gaming aspect is in the foreground and the earning potential is rather limited, I would say it's probably not a business. I am aware that there also are play per earn games where you can make a full-time income on it. That's probably then more likely a business income, but that is something you really need to individually check with your tax advisor case by case. There is not a like one answer for everything. The technical implementation does not really matter if it's a ERC20 token or any of the other newer standards of these gaming tokens or NFTs. So that's completely irrelevant for that. And if you can trade the tokens that you received through that play per earn, that just shows that it like has actual value, that like shows the value, and it's kind of a good thing because then it's easier to create a market price because you need to find out a market price at the time that you can earn them. So you're not really relevant for the question, but a good side effect if you have a market price for whatever you earned. I would say probably if you do that in a small to medium amount as more of a hobby, it would probably be other income, therefore taxed with your personal tax rate, and you tax the assets already at the time when you receive them. And then again, the difference when you're selling them. So let's say you play that game, you play per earn, have now 100 tokens. These 100 tokens are worth 100 euro. You sell them, token price goes up, you sell them for 200 euros. So you tax the 100 euro once you receive them, and the 200 minus 100, so the other 100 euro once you sell them. Unless you hold them for over 1 year, you're the same 1 year holding period, then it's completely tax-free if you sell them after 1 year.
Great.
Quite intense questions from the community. You can see you have some experts there.
Yeah, indeed. So, well, thank you so much, Werner, for talking about crypto tax with us today, and also giving you your, your insights. And thanks everyone for watching. And please feel free to subscribe to our YouTube channel. And see you at the next episode on BerChain YouTube. Bye.
Thank you. Bye-bye.